Stocks posting, as we said, modest losses today after Friday's very strong rally, but we have a big week of earnings ahead of us. How should you be positioning your portfolio longer term? Let's bring in Matt Roddy, Vice President and Portfolio Manager with Rockland Trust, and Christina Hooper, Global Market Strategist with Christina, I thought stocks weren't allowed to go down. What is happening today?
Should we sell everything?
Sell the house, sell the car, sell the kids. No, seriously. Is there any time in this market that we are going to have to worry? Because I guarantee you, if we don't have a gain tomorrow, there'll be some chatter because we've had 1 day down and 5 up. That's how it's gone for about 2 years.
There's nothing I would argue to worry about, that there are very significant risks. So I think the bias is upwards for the stock market. We've got a strong global growth picture. The IMF confirmed that just the other day and actually upgraded forecasts for growth globally. We also have very accommodative monetary policy. So the risks lie within that picture, and that is, first and foremost, a monetary policy error. More tightening than expected.
Do you have kids?
I do.
Okay, so you know when you tell a kid don't do something, you might get hurt, and they ignore you, they ignore you, they ignore you, and the more it happens, they don't get hurt, they just keep ignoring you more until finally they do get hurt, perhaps, or they break that glass, they break or whatever. So here's my question. Investors, we've been hearing about these risks for years. North Korea, Trump, price to earnings. And guess what? I worry now we're at a stage where everybody's just ignoring everything and buying it. Last week, we had the biggest inflow of money in the history of the stock market, ever.
And that's a very good point. What I would do is refer back to the old adage of Warren Buffett: when everyone's getting greedy, it's time to be fearful, and vice versa. I wouldn't say fearful, but be careful. Remind ourselves of the important tenets of investing that have really benefited investors over the long term, like diversification. We need to be thinking more in terms of 50-30-20, 50% equities, 30% fixed income, well-diversified fixed income, and 20% alternatives. We want some lower correlating, close to non-correlating asset classes in there, because we could have periods of disappointment, even though there is an upward bias to stocks.
Hey, Matt, you worried about rising interest rates?
Yeah, I mean, in the long run I am. Not right away, though. I do think we're in a reflationary environment here, and we're finally starting to see the yield curve kind of push up, at least out to 10 years. The 30 years actually still below where it was a year ago. And that's a good sign. We don't want to be on a flat yield curve. That can suck the life out of the markets, as banks are not likely to lend if they're not making anything on the spread there. So I'm worried in 19, maybe even out to 20, as the short-term rates start to approach 3%, and we're starting to look at 4 and 5% long-term rates, what that does. But I think we can trade through the Fed's 3 increases this year and be higher by the end of the year. And there might be some short-term consolidation along the way, but anything we dip, in the first half of the year, I think we get back in the second.
Matt, no one ever lost money taking profits judiciously. Is now the time?
Yes, absolutely. I look at my portfolios, and when I'm going in, I'm rebalancing back to strategic targets. I'm looking at technology up almost 40% last year, and I'm looking for sectors that are a little bit more beaten down, things that, like in the energy market, which is starting to finally come around in this reflation trade, is an area that I'm rebalancing from and to. So I do think taking profits here is a wise thing to do.
Anything I should sell, Christina?
I wouldn't necessarily argue you should sell unless you're pretty significantly overweight. For example, domestic equities. We want to make sure that we are not overexposed there. There are a lot of opportunities in international equities, and valuations look more attractive for some, particularly EM.
All right. Thank you, Guy. Thank you, lady.
Thank you.
Thank you.
And don't forget dividends.
Never. There's a little extra juice you get.